1.2. Looking to buy at this price. So if you follow our trades, let's see if it will get executed quickly. So any chances in a second? Oh, okay. Just open new position on euro against United States dollar at 121.12.
Pandemic, and so many people are still lacking the infrastructure. So many people are still lacking the connectivity that they need in order to get their work done, make sure that their kids are able to attend class without interruption. Why is that? And what are the obstacles that we still need to remove as a society?
Well, I think there are a couple of issues that exist. One is just pure high-speed connectivity, and there are many areas in our country that the economics alone would never incent some of our communication services providers to actually go build it out, because the ROI on the investment isn't there. And that's where it's going to require, joint funding between the government and the private sector. And I think in some of our inner city areas, it's just an issue of poverty, and it's an issue of the inequality, and people just don't have the technology. Even if they do have high bandwidth available, they may not be able to afford it. They may not have the appropriate devices to actually then connect and experience this virtual learning environment. So it's a number of issues. We know what they are, and we just need to work together to figure out solutions.
What about the regulatory environment that, we saw a very, sometimes very harmonious and sometimes very strained relationship between the previous administration and the tech industry as well as others. How do you expect the regulatory environment to change under President Biden?
Well, first and foremost, I think that the technology industry, we have become a core, backbone element, whether it's the technology we build, whether it's the platform players, have become the foundation for the global economy. Much like the banking system is critical, much like the energy systems are critical, the technology systems are critical for the global economy to operate. And so the notion that it needs to be regulated, to me, is quite obvious. And I think the opportunity with the Biden administration is, I think there's an opportunity for a real candid dialogue, a real open dialogue, and for us to get to some practical regulatory, strategies. I have said in the past, I actually feel, quite sorry for the folks in Washington and in other countries around the world who are trying to keep up with this technology as a side job and actually apply regulation against technology that's moving so rapidly. And I think it's going to require us to spend time together to educate each other and actually work together to come up with the appropriate regulation in today's world. But it definitely needs to happen.
It's hard to look back on 2020 without reflecting on the racial reckoning that we saw across the country in light of the events surrounding George Floyd's death. Cisco was one of the companies that took a real strong stance, talking about the need for real change, talking about systemic racism. How do you take that in a world where there's not even agreement on whether there is systemic racism?
Well, first of all, I think that as CEOs, I don't think we have the option of sitting on the sidelines any longer. I don't think our employees, our constituents, no one's going to allow us to sit out these discussions. And I think it's easy to be out there and be bold when things are going well and things are working in your favor. But when there are complex issues, I think it requires all of us to step up, and it requires us to all be clear when the answer is obvious and when the situation is obvious. We need to exert leadership. And I would say that 2020 was a year where we needed as much leadership as we could possibly find. And many of my peers and colleagues were out there. We had lots of discussions with each other through venues like the Business Roundtable, where we shared thoughts and ideas about what we were thinking. And we just tried to come together and be a positive force in the midst of a very complex time. And I think that, we did. Now, look, everybody has their own opinions, and certainly social media gives everybody a platform to express their opinions. So you can expect that kind of thing. You can expect some negative comments, but I think that's what leadership's about. Is when it's a tough situation, you stand up for what's right, and when it's just so clear, it doesn't matter what people say. You just have to do the right thing.
And one of the things that you've said in public statements is that, there's a lot more work to be done. Can you talk a little bit about what that work looks like, and what is Cisco doing to help make that change come about?
Yes, we have a team of people that have worked really hard on putting together our social justice strategy and the subsequent initiatives that we're going to be driving, the investments we're going to make. It's a group of very energized employees who are going to keep it moving forward, and I meet with them regularly to just get updates and make any decisions that we need to make. And I think that that's what every CEO needs to do. It's no different than an important business project that you would be running inside your company. You're going to stay close to it. You're going to create accountability. You're going to create milestones, and you're going to inspect it. And I think we have to look at this in exactly the same way. And I think that's the way we're doing it, as well as most of my peers are doing it.
I want to get back to your business a little bit and talk about the transformation that Cisco has been undergoing over the last several years, where you're trying to transform your business from being a provider of hardware into one that's much more software and services oriented. Can you talk about the milestones that you've achieved in that effort?
Yeah, Tom, it's a great question. So in 2017, we did an analyst conference, and we set a target of having greater than 50% of our business come from software and services by the end of fiscal 20. And we achieved that. It was 51% at the end of our fiscal year that just ended. And we're currently working through sort of what are the next wave of milestones that we will, take forward to the street. But I think we have made great progress. We had when I became CEO, we had about a $3.3 billion SaaS and subscription software business, and we exited FY20 almost at $11 billion. So we have added to that very significantly. We still build great hardware. These massive 5G networks, where we're working with 30 providers around the world today, they need high-speed, high-performance hardware to run these backbones of these networks. So that's not going away. But to the extent we can solve problems for our customers with software, it's just faster and it's easier. And we're going to continue making the move in that direction. We'll continue adding more and more software assets to our business. But I think that we've made a great deal of progress. We still have a ways to go, but I'm proud of what the teams have done.
So to reach that milestone in 2020, can we talk about what's next? What do you do? What's the next big milestone, and how long before you're ready to start outlining that in your conversations with investors?
Yeah, we're going to look at a whole series of new metrics around a lot of our SaaS businesses in particular. We're going to get more consistent with reporting of metrics like incremental ARR and the real metrics that traditional SaaS and subscription companies would report. We have a great new CFO, Scott Herron, who joined us from Autodesk. He and I are going to spend several months building out our model, looking at the implications of a lot of the investments that we're making. And I'd say middle of this year, hopefully we'll be prepared to have a broader discussion on that very topic.
Lastly, I want to talk about the 5G rollout. You're a company that provides the services and the hardware to those companies, those providers that are at the forefront of this rollout. There was a lot of hype behind the 5G and the ways that it would change the way we work, the way we play, the way we interact with machines, and the way those machines change our lives. I'd like to hear from you your sense of why, for some, has the 5G rollout been a disappointment? Why is it not living up to the hype?
Well, I think it's a matter of timing, right? I think that it will live up to the hype. Trust me. I think we're just in the early days, and it's going to go through phases. And right now, the big rollout that you see happening right now is for the consumer handset 5G services. And if you just go back to 2007-8 when we had the 4G transition, at the time, you could have said the same thing. And then what happened is once it rolled out, you saw all this innovation, you saw smartphones, you saw new applications being built, streaming became, a real viable technology. And I think that we're on the very front end of deploying the 5G technology to the consumer. I think our customers will build out 5G enterprise services, and then I think you'll see a lot of innovation follow. We don't know what that's going to look like, but I think the performance, the low latency, and the inherent value that has been hyped, so to speak, about 5G, I think it will come to fruition over the next few years, and we're just in the early days.
This is Tom Giles with Bloomberg News, and I've been speaking with Cisco CEO Chuck Robbins. Chuck, thank you so much for being with us today.
Thank you, Tom.
Hello, my name is Eric Balchunas, and I'm Senior ETF Analyst for Bloomberg Intelligence. And today I'm going to be going over the ETF landscape, which includes mutual funds. Our team covers mostly ETFs, but we also work in the mutual fund industry because a lot of the same companies are issuing both products. So, and I think it's very relevant for my presentation today, which we call the battle for active. We know that ETFs have taken in a ton of money into what we call cheap beta, Vanguard, BlackRock. They've taken about 70% of the cash every year, but there's about 30% left over for active. And a lot of bigger legacy mutual fund companies are starting to come in and try to get a piece of the ETF action. And I think that's what the big theme for us is going to be next year. So let me go through some slides here. Last year, ETFs took in about $500 billion, which was a record. We think next year they'll probably pull that off, but they could even go to $600 billion if you consider what we call the big active bump. These would be flows coming in from these big mutual fund companies that are sitting on upwards of $10 trillion. They have a lot of money, but they have organic growth problems. So they may actually bring over some money to get something going in the ETF space, and that could be worth about $100 billion. I'll show you how we get there. First, the problem for active mutual funds is they have no growth. Their assets are fine. They've gone from $3 trillion to $6 trillion over the last 10 years, but that's only because the market's up so much. Flow-wise, they lost $2.3 trillion in outflows. So it's kind of a mirage situationally, and a bear market could really see their assets decline quickly, we think. So right now they're reading the writing on the wall, and they're going into ETFs to try to appeal to younger investors, RIAs, and try to get their strategies in those hands. So one way, one other slide I want to show is just that right now in the equity world, half of the assets are now passive in terms of fund assets. So again, this is part of that idea that at some point you're going to have to sort of move.
Well, put stop on profit for euro, and I'm going to place it at 121.14. Just right here. Never stop loss, right? Okay, let's see how far it will go, and I would have to put my stop on profit even further. It's great, yeah? We'll make good profit. Speak to you later, guys.
We didn't think they would. It's tough to get assets in ETFs. And their active share is interesting. This is something I want to talk about throughout this presentation, is a little higher than it is on the mutual fund side. And we think that's probably smart. That said, their fees are going to make it difficult. A lot of the money goes to funds that are charged less than 20 basis points. So when you're at 40 to 60, it makes it tough. You have to perform. So besides active non-transparent, another way that mutual funds are going to come over is through conversions. They're literally going to just convert a mutual fund into an ETF. The SEC should approve this. DFA has announced the first one. That's going to be $32 billion to tax managed funds. So these investors will go to sleep one night with a mutual fund, and they will wake up with an ETF. And there's been 3 or 4 other companies who have followed suit. DFA is a leader, and we think that ultimately 30 plus maybe another 20 billion. So 50, 60 billion could come over in just conversions alone next year. And here's the thing with all the ETF flows generally go to one or two places, dirt cheap or shiny objects. It's not so much active or passive. It's just those two things. Here's the deciles of flows between cheap and expensive. and best and worst performing. And you can see upper left obviously is good, but on the far right, if you can crush it, if you can do really well, you can overcome the fee obsession that these advisors have and retail investors. So we try to explain to people that those are the two places that flows are going, and they should really design their products accordingly. The middle is the tough spot, and this because portfolios are changing. Most people's portfolios now are barbelled. They have real low-cost, cheap beta as the core, and then they take some chances on the outside. And, of course, they're going to want something very different when they take those chances. We, on the team, frequently refer to it as the hot sauce. We look at ETFs being designed for this pop potential, which we call the hot sauce, so to speak. If you look at all the launches in 2020, the number of holdings they have is shrinking. In other words, they're more and more concentrated so that they can actually have more of a chance to not just beat the index, but really beat it and get some attention. And again, get some of that shine going that is required. At least that's what the flows are showing us. Now, no better example of this shiny object than ARK. ARK has gone from 4 billion to about 44 billion in less than a year. That's a tenfold increase. I put PIMCO in there, who's no slouch. They have a good ETF business, just so you can see how crazy ARK's rise has been. And ARK is high cost, stock picking, and they're independent. So any one of those three things in the ETF world makes your life pretty difficult. They're all three, and they found success. And they did that because they are shiny objects all over the place. They have a couple ETFs, and all of their strategies seem to be working. Whether it's the main flagship fund or the genomics fund, even the 3D printing ETF is starting to find a little pop lately. So you can see how much these funds are not just beating the S&P and the Qs, but they're lapping them. And that has been the deciding. Now, of course, we know this might not last. The Janus 20 was a big deal 20 years ago. That fell on hard times. We've seen this where these high flyers do come down to earth. And so we're not saying it will last forever. We're just saying that tends to be what attracts flows. Now, DFA is interesting. They're not doing ants. They're going to issue transparent active, but they're also going to do it cheap. And so their active ETFs are 12 to 15 basis points. So again, because they're dirt cheap, we think they have a good chance. And they've already seen some inflows since they launched. And it's interesting, Goldman took this route too with their smart beta. GSLC is 9 basis points. And that has been very good. I think last I checked, it's around the $10 billion mark. So again, if you sell an active brand name active strategy for Vanguard fees, you're probably going to succeed. That's another way to do this. And if not, there's always BYOA, which is bring your own assets. And this is where if you have a network of advisors, or you have some in-house money, or you just have mutual fund investors that you can bring over, this is a look at issuers by their percentage of assets that are in-house or internal assets. And you can see some issuers do it a lot, some not so much. But again, we think maybe upwards of 20 billion could come over next year through this BYOA process. And all this big active, these traditional active managers are coming over, and whatever route they choose to go, organically, they're going to have to fight what we call new active. So new active is using an index, it's rules-based, but it's definitely doing an active strategy. That would be thematics, smart beta, and ESG. All of those are deviating from the benchmark. And you can see that in the last year, smart beta has really lost market share to themes, ESG, and stock picking, namely Cathie Wood, and ARK is that white bar there. And so we think smart beta, which for years dominated this sort of non-beta portion of the pie, is now going to be a much more competitive place. You can see here, this is the pie. This is what everybody's going to be fighting over, because this is where you can actually make some money. That's 25% of the ETF pie. The other 75% is basically going to fees that are less than 10 basis points. So if you're looking for revenue, not a lot of action is going to happen there. So largely the innovation is going to be for this slice of the pie. And that's what we're seeing. And now real quick, this has almost nothing to do with what I just talked about, except for the fact that it was a big issue and something we're watching next year as well. The S&P 500, we feel, probably took a hit to its brand. Adding Tesla so late, delaying it, and reminding everybody that this index is run by a human committee. And it kind of proves there is no such thing as true passive. That's why we like to go with dirt cheap and shiny objects rather than active and passive. So the S&P still gets a lot of flows because those indexes and ETFs are very cheap. But look at how the S&P lagged other, quote, beta indexes, namely the Russell 1000, and a few others. And Q's, obviously, that's not quite beta, but this is a year in which it reminded us that not all beta is the same, and the S&P lagged what will be considered straight beta by about 100 basis points because it added Tesla so late. And in the past 6 months, all the S&P 500 ETFs and indexes have seen outflows for the first time in a long time. You rarely see them see outflows. So we think some of this money could go over to the total market indexes like VTI, which has held Tesla for 10 years. You don't have to worry about when those stocks are getting added. So that's something to watch too, is this sort of battle for beta. That's a sort of a separate issue. But largely, I think much of the action is going to happen in this battle for the slice of non-beta cash, which again is about 30% of the inflows each year. So with that, that's what we're watching. If you need to reach out to us, here's our email, our Twitter handles. We interact with people over there too. And if you are interested in podcasts, I co-host one called Trillions on the ETF industry and highly recommend it. It's on iTunes. Thank you very much.
Hello, everyone. I'm Peter Grauer, the chairman of Bloomberg, and I am delighted to welcome everyone here today. Although we can't be together in person, an event like this reminds us of what connects us and the values we share, even at a distance. Now in its 6th year, the Bloomberg Gender Equality Index, or GEI, has been shedding light on a previously dark area of ESG reporting among public companies, gender-related practices and policies. And as more companies have come to recognize the business case for fostering an inclusive environment, the GEI has grown year over year. This year's index is larger than ever. 380 global companies spanning 11 sectors, headquartered across 44 countries and regions, have taken part. For the first time, companies domiciled in Indonesia and Bermuda are reporting gender-related data, and we're delighted to welcome some incredible new participants, including our good friends at BlackRock and NASDAQ. Not only are more companies disclosing data than ever before, but the quality of disclosure continues to improve. For example, GEI companies had a 94% disclosure score on average. And although we raised the threshold for inclusion in the 2021 index, we are still seeing record numbers of companies disclosing data. The past 12 months have been hard on everyone. And increasingly, we are seeing that the S, environmental social governance, ESG data, has become more important to companies than ever before. Firms that provide an inclusive environment, supporting work-life balance and flexible work arrangements, will eventually succeed in retaining a talented workforce and gain a competitive advantage in a business environment that has been significantly altered by COVID-19, possibly forever. I want to close by thanking companies that are committing to solving the important issue of gender equality by disclosing data on their efforts to support gender equality through policy development, representation, and transparency. Their efforts are creating accountability within their industries, collectively driving real change. I wish everyone a healthy and profitable 2021, and I'm looking forward to the rest of the program. And now I'd like to turn it over to Patricia Torres, Global Head of Sustainable Finance Solutions at Bloomberg, to provide some further insights into this year's GEI. Patricia?
Thank you, Peter. I'm happy to be here today to share with you some of the highlights from this year's index. As Peter mentioned, in today's virtual working world, it's more important than ever that companies maintain a strong corporate culture, as the decisions companies make today can drive progress on equality for years to come. This progress begins with the GEI. By using...
Okay, guys, we closed position, as you can see, on euro at 121.14. Okay, so all of you who follow my trades, you should get profit, and you should close your position because at this point the momentum change and you never know what's going to happen. It might go one way, it might go to another way. According to our strategy, we just collected profit. Okay, speak to you later, guys.
Inclusive work environments, with 87% of companies included in the GEI providing flexible working hours. Second, these companies are working to close the gap through female leadership. On average, 29% of GEI members' boards are women, and more than half of the companies require a gender-diverse slate of candidates for management positions. Next, these companies are hiring more women than they are losing, and 69% have specific strategies for recruiting more women. These firms are also addressing equal pay, with 59% conducting a global gender-based compensation review and 40% publishing their global results by gender. And finally, they're investing in their local community.